Welcome to Real Money, Real Life, the podcast where we get real about money and the messy human stuff that comes with it. I'm Linda Grizely, financial educator and your Me Money guide to financial clarity. Each week, we dive into financial concepts and money strategies, but we always tie it back to real life, emotions, mindset, and how money actually shows up day to day. If you're ready for practical tools, mindset shifts, and honest conversations that meet you where you are, not where the world thinks you should be, you're in the right place. Because you deserve to feel confident with your money and good about how you use it. No judgment, no lectures, and definitely no putting yourself last.
Hello, everyone. If you are listening, you're one of the real ones, the ones who want to protect themselves before a financial mistake becomes a financial disaster. Today, we're talking about preventing investment fraud and financial advisor misconduct. Investment fraud is far more common than most people realize, and it often hides behind trust, authority, and complexity. In this episode, we'll focus on the real world red flags that investors should know, how fraud begins, and what everyday people can do to protect themselves before handing over their money. Today, we're joined by James Brandolino, a leading expert in investment fraud prevention. What makes James uniquely qualified is his extraordinary journey from being an investment fraudster to a fraud prevention expert. After starting as a securities broker and later managing a hedge fund, James made the devastating decision to alter investor statements and cover trading losses with personal funds for over 8 years, ultimately leading to a federal conviction and 6.5 years in prison. During his incarceration, he studied forensic accounting and analyzed investment fraud cases, transforming his firsthand knowledge of fraudulent tactics into a mission to protect others. Today, James helps investors and organizations identify critical red flags and safeguard their assets from the very schemes he once perpetrated. Welcome, James.
Thank you, Linda. Appreciate the invitation.
Yeah, and I especially am intrigued. We met in person at an event and we talked about this, and I thought, wow, this is really something that I need to learn more about. And more importantly, my audience needs to learn more about. So I'm really looking forward to this conversation.
Well, I really hope that I can add value and content that both you and your audience can use and stay protected.
Yeah. One of the things that I talk about is how it's really hard to know who to trust. And I think that's a big point in this conversation, but we'll get it more into that. What I want to know first though is what drew you into the investment world to begin with and what eventually led you to do the things that you did?
Okay, well, the first part is pretty easy. When I was a sophomore in high school in June of '83 with the movie Trading Places with Dan Aykroyd and Eddie Murphy, and they were on the trading floor at the New York Board of Trade, and I just was mesmerized by that. And when I realized soon after that, boy, in Chicago, we have 3 exchanges. We have the Chicago Board of Trade, the Mercantile Exchange, and the Options Exchange. Wow, when I go to college or after college, I can get a job there and start my career on the trading floor. And that's really how it all started. I worked as a broker at Charles Schwab. I was a operations manager at a very large derivatives firm called MF Global. And I ran some trading desks as well. And it came to the point where I had 3 years of profitable trading under my belt. And I go, let's start a fund, become a member of the board of trade and manage money for clients. And the catalyst in my fraud case is very simple. I traded treasury bond futures. And when I got to the trading floor, I had to wait for about a week for the board of trade to put in all of the equipment in my desk and the high-speed internet line. And as I'm waiting this week, I'm watching the stock index futures, the S&Ps and the Dow Jones futures instead of the 30-year treasury bonds as I traded. And I was mesmerized by how fast those markets moved. And I'm thinking to myself, my returns at the time were 6.5%, 7.5% per annum, which were okay back then in 2003. But boy, what if my clients thought that wasn't good enough? If all I had to do was maybe make a couple changes to my financial model and trade stock index futures, I could earn 10%, 11%, and I'd be a hero. So really just on that whim that my clients would not appreciate my lower returns, I made some changes to my trading model and started trading. And literally in a week and a half, I was down 3%. Now, this is the first week of trading. This is family, friends, and longstanding brokerage clients. And, we had months where we lost more than 3%, right? And where I would stop trading. But this was, I just became a new member of the board of trade. I'm trading my own fund. This is my own thing going on. And I felt, there's no way I can go to these guys and tell them, that we're down 3%. So I was just fearful that I'd spent all this money on legal to get all the documents done and get the CPA firm that's going to come in and do all of the reporting. I made a decision and I said, I'm just going to buy software, accounting software, and I'm going to send the first month statements showing a gain instead of a loss. Because 3% I had traded, besides trading for brokerage clients, I had traded for myself for many, many years and was very successful. So the point came to where, I just need a couple weeks, 3 weeks, a month to make this back, and we'll make the statements correct and everything will be fine. Well, of course, that's not how it happened. Minus 3%, minus 6%, minus 12%, minus 24%. And it just kind of kept snowballing. And the whole point of the story is that despite my high net worth accredited investors doing either their own due diligence or having their CPAs and or attorneys perform quite a bit of due diligence, that my fraud was never caught. The banks, the brokerage firms, the SEC, everybody, nobody found out about my fraud. And that was the most interesting part. So really, after literally 8 years to the day, I came to the conclusion that, we're down $4 million. If I haven't made it back by now, I'm not going to make it back. I'm not going to continue raising money and hiding losses and lying to investors. So I decided just to turn myself in. And I walked into the U.S. Attorney's office downtown Chicago and with the FBI waiting and said, this is who I am. This is what I did. Go ahead and incarcerate me. And I pled guilty to one count of mail fraud for sending fictitious statements in the mail and served 6.5 years in federal prison. But despite that fact, the fact that I turned myself in and there was never any FBI investigation, no SEC inquiries, no subpoenas, that's one part of the story. But that's not even really the most important part of the story. The most important part of the story, Linda, is that no one caught the fraud. No one caught it.
Yeah.
And that's what's most terrifying, really, that investors should take from this. That, okay, yes, I was a professional. Yes, I didn't wake up one day and decide that I wanted to commit fraud, right? And did so. I had a great career in the financial industry, and my resume was pretty impressive, and there was nothing in that background. But when it came to red flags, they were all over the place, and nobody caught them.
Wow, what a story. And kudos to you for turning yourself in and not just perpetuating it, because it could have gone on for who knows how long before anyone finally found out.
Correct.
And it would have just kept getting worse. And I think, not that I'm condoning it by any means, but I think it's easy to see how someone could be like, oh gosh, I just need to cover this little thing up and it'll all fix itself and then everything will be fine and nobody will ever know. And then it just keeps getting worse and worse. It's like, telling one little white lie and then it just starts to snowball, right? So I can easily see how
Yeah.
that sort of thing could happen. Not that I would do that myself or anything, but I can see how it
Right.
would. Right.
Right. And I think most people really need to understand that many cases of investment fraud don't begin as investment fraud. Most bad actors don't wake up one morning and they're sick and tired of, making $20,000 a year working at Amazon, right? And decide, I'm going to start a hedge fund, a private equity fund, some type of fund. I'm going to raise a lot of money from investors. And when I get that call or knock on the door, I'm going to go out the back door, head to the airport and get on a plane to a country that will not extradite me back here. And that's really not how it happens. It happens out of fear, right? It happens out of public embarrassment and avoiding that type of thing. And I felt myself personally that I just could not go in front of my investors and tell them, oh my God, I know it's only the first month, but we're down 3%. Now, in hindsight, what I should have said, hey, we're down 3%. Whoever wants to leave can leave. And if they all left, okay, and I have to close the fund, okay, I'm out $30,000 from all of the legal expenses and accounting expenses that I paid, but okay, I'll trade for myself. And, in 2, 3, 4, 5 years, we'll start it again. So that was my bigger concern. Now, if my clients maybe it were like a bank or another hedge fund, then it probably would have been much different. But I just felt that because I knew every one of my clients, they weren't just names on a spreadsheet, friends, family, et cetera, that I just was terrified of calling them up and saying, we're down 3%. And you think 3%, I'm like, I think 3% now. It's like, oh my God, that's nothing, right? Well, I mean, to me, it was. And
Yeah.
that's really how most investment fraud starts. Because I told myself, I can fix this. It's a short-term setback. 3%. I mean, I've traded for a long time. I'm not lying to investors. I'm just buying more time just to trade my way back to profitability. And it just never happened. It's hard enough to trade profitably anyway, but when if you're trading your own money, it's hard. But when you have investors behind you, it's a lot more pressure. And I just failed to do so.
Yeah. Okay, so let's talk about from the investor's standpoint, what are they looking for? What are warning signs, red flags? What should we be watching for?
Okay, so there's two areas of fraud that I want to talk about, or I'll let you kind of guide where we go with this. So there's investment fraud. When you think investment fraud, think of like the Bernie Madoff situation, or situation where you're investing in a private investment, a hedge fund, a multifamily real estate deal, anything that would be an exempt security, not sold by a broker. And then you've got the other side, which is financial advisor misconduct, which is misconduct by licensed and registered insurance people and financial advisors, registered investment advisors. In both cases, there's 2 points. You want to know who you're doing business with. Now, on the financial advisor side, it's a lot easier because you have broker check. You've got other things that, you can't get licensed if you have a felony, if you've declared bankruptcy, if you have certain outside activities, all of that stuff will be disclosed. You still need to know who you're dealing with. But when you're not dealing with a licensed individual, it's much more important to go in and know their background, know their litigation history, know their resume. Is their resume for real? Is it can it be verified? But more important, and this is on both sides, are the people who you're investing with, are they doing what they say they should be doing, right? So on the investment fraud side, are the profits that are generated, are they coming from legitimate operations, or are your returns coming from new investors' money that's coming in, right? Which would be a Ponzi scheme. It's a little more clear cut on the financial advisor side, because you're having conversations, you're talking about risk tolerance, and you could probably comment on this as well, Linda. And then the financial advisor will make certain recommendations for investments, and those will be all paper trailed onto monthly statements and annual statements, and you can kind of see how they work. In terms of financial advisor misconduct, and maybe we'll stick there for a little bit, I took some pages out of my book to make sure I don't miss anything. Probably the largest number of instances that we're seeing in terms of financial advisors is switching, mutual fund switching and annuity switching, meaning a financial advisor finds out that a particular investor will have mutual funds or annuities at a different firm, and they transfer them in. And of course, the financial advisor is going to do an evaluation. And of course, 99% of the time, the evaluation is going to be, well, these are okay, but boy, we've got products that are 10 times better than this, and better returns, less risk, more benefits. And that may be true. However, the term switching means is that the investor is being sold something that may not be right for them. It may not be a good replacement for what they already have. And it's just a tactic used by the financial advisor to generate commission, which I have no problem with advisors generating commission. I have no problem with that at all. But when it's at the detriment of the client, that's definitely not a good thing. A few
Yeah,
other
I
points
have
I
my own
wanted to,
opinions.
yes,
I have my own
please.
opinions on that
Yes.
about
I'm sure
financial
you do.
advisors who earn commissions.
Yeah, well,
Um,
look, I don't necessarily have a problem with it as long as they're offering value. And I'll even say this, and I've not seen this anywhere, and I'm sure somebody has said it other than myself. I'm not that smart to maybe come up with this myself. But look, even if an advisor is charging what would be considered not high fees, but okay, average fees to an investor, and basically those fees and the relationship that those two parties have allow the investor to stay with the market, right, for a long period of time and not get scared, and not every time the market goes down 2%, which it doesn't do very often now, but that's another story. But it keeps the investor in the market and able to take advantage of these large upswings that we've seen. Really, I don't have a problem with that, because there are some advisors who charge really low fees and they don't have that relationship, and that, the maybe the investor is kind of calling the shots a little bit more and kind of in and out on certain things. And not that they're not making money, but I think that just that long haul mentality, it comes at a cost. And if over the life of the account, if that investor had to pay another $25,000 or $50,000 on $1 million account, but the only reason they've got that $1 million account or $2 million account is because they had someone who could settle them down when the market got crazy, or when the news headlines went bonkers, or a president said this or a country did that, and just stay with the course, then I think it's absolutely worth it. But that's just one opinion.
Makes sense. Okay, so I didn't mean to cut you off. Continue with
No,
your advisor misconduct,
yeah,
thinking there.
yeah. So I wanted to definitely mention deceptive illustrations and hypothetical performance. This is more on mutual funds and annuities. And this is starting to change a little bit, but a lot of the insurance companies have software that advisors can use and basically create these illustrations of basically growth. Meaning, if you put $50,000 into this annuity or $100,000 into this mutual fund, and it'll draw this great graph. And there's all of these assumptions that either are in an 8 font at the bottom or on the next page that typically the investor will not see, or they don't even have to be included. And it's very deceptive to show graphs that don't have all of these hidden fees and everything in those graphs. And that there's a lot of, I wouldn't even say litigation, but just a lot of complaints by investors, going to their broker dealer firms. And of course, they're not going to court because the broker dealers know that that shouldn't be happening. Now, there are a few insurance firm companies that basically will not allow those types of illustrations to be printed, meaning the fees have to be included. Of course, you can adjust the toggle, either more fees or less fees. You can change certain assumptions to make that chart more rosy or more realistic, let's say, but it's something that investors absolutely have to be aware of. Something small that we see: failure to follow instructions. Advisors who are supposed to place stop orders on different things and different securities and don't do it. That's not a huge thing. Misrepresentation of fact. That's huge. Downplaying risk and overplaying return on investments. You see a lot of that in limited partnerships. Excessive trading, unauthorized trading. Are there trades in your account that you don't recognize, even if they're profitable? You have to, right away, you have to bring that up to your broker's attention. And probably the most damaging type of scenario that we're starting to see in the last couple of years that are really increasing is a concept called selling away. And selling away is where financial advisors will advise their clients to write a check to an investment that their broker dealer does not support. And I'll give you an example. So this could be a legitimate or illegitimate fund type of investment. It could be real estate. It could be any type of trading vehicle. And it's going to be XYZ hedge fund. And what's going to happen is this is not supported by the broker dealer, and either the broker controls the account where that money goes, or someone that he knows controls it. So basically, the financial advisor would tell their client, you should put $50,000 or $100,000 into this fund. It's going to earn this percent per year. That's what we're looking at. So basically, the client writes a check out of his account or just out of his bank account, and it's going directly into a fund that the broker can access. And basically, there's no trading going on at all. And easiest way to do that is to ensure that whatever the broker is recommending that you invest in, that they are authorized to sell it. And it's either not even asking the broker, it's calling up and calling the compliance department at the broker dealer saying, hey, my broker told me to invest in XYZ fund. You know, it's not an exchange. It sounds like it's a private investment. Do you guys offer this? And he'll say yes or no. And if he says no, then, there's going to be a big problem with the broker. But selling away is basically for investors to take their money away from the brokerage firm and putting it into something illegitimate that the broker is controlling or the broker's friends are controlling, and they're splitting profits on that. And we're seeing a lot more of that, and not necessarily on crypto stuff as well. It could be an annuity that looks legitimate. It could be any type of product that looks legitimate, but it isn't.
So these are all great. I think I wrote these down, but I'm not sure I got them all. We covered illustrations, so showing a projected return from a typical investment, like maybe an annuity or something
Sure.
that might
Well,
not be fully clear on what that looks like, and it's not guaranteed.
so using the word misrepresentation is might be a little bit strong, but when a financial advisor knowingly is toggling the default settings on that software to make that chart in looking at 10 years of this investment be a lot greater than it probably normally would be, it really is misrepresentation.
Okay.
And
So
the, and, the, and
how would a person see or know what to ask about how something's being represented in that matter?
Okay, so rule number one, when you receive any type of illustration, and it could be a chart, it could be a table, a combination. Advisors love to give charts out because it's something that's relatively easy to understand. You can say, okay, I have $50,000 here, and in 10 years, I've got $627,000. And okay, I can see that. Your antenna should go up right away, and you want to know what exact assumptions are in that model. Are all of the fees, and not just the commissions, if it could be 12b1 fees for mutual funds, it could be admin fees, any type of fees for mutual funds and or annuities, and you want to make sure those are all included in there. You want to know what type of annual rate of return is being used. Typically they will use 10%. I know advisors who will run one for 8% and 9% and 10%, saying, okay, 10% is our historical average, but what if we do 9%? Okay, you're not going to have 627,000, you're going to have 515,000. And if we use 8%, say there's a little bit of a downturn a little bit, it's going to go down. I'm just making up numbers here. But you want to know what assumptions are being used for rate of return. You want to know what type of holding periods there are if you have to keep the money in, especially for annuities for 1 year, 5 years, 10 years, whatever it may be. You want to know all the assumptions that are used in that model to get that final number of $627,000.
Okay. And then the other thing you mentioned was trading. So we're talking about excessive trading or trades that just don't look familiar to you. And so tell us
Correct.
a little bit more about that. Expand on that one.
So that's probably slightly less common now, only because a lot of financial advisors and registered investment advisors are using what are called managed accounts. So a registered investment advisor is just basically putting trades in the account, and they're paying a management fee, and that's at 1%, 0.5%, 2%, whatever it may be per annum. And they're not being charged commission. But there are still quite a few advisors with a lot of firms that may not be in the top, in the top 10 or the top 15, that are placing trades in accounts. And what they'll do is they'll place certain trades. Of course, they would all like them to be winning trades, because if a trade makes $1,000 and they can pull 400 out as commission, they'll look like a hero. And they can tell the client anything. Well, yeah, we had this trade, and yeah, I just put it in your account, and here it's for you, right? Yeah, they can say whatever they want. But certain trades, they're going to put the losing trades, they're going to put in somebody else's, in an account that's not going to maybe look at it quite often or quite as easily. Or what they can do, this is something that I did because I knew the back office operations. I could move trades from the hedge fund. I could put them in in an error account, I can put them somewhere for a couple days, and then after they settled, I could put them into the hedge fund, and they would just appear. They would not appear as a new transaction. They would appear just in the position part. So if you have 2 pages of positions this long, unless you're going a line item each one, you're never going to know they're there, right? Or you put the buy sell in there, and if you put it in after they settle, you're not going to see the buy and sell at the top of the page. You won't even see them in the positions. You'll just see the net P&L in the account equity, but you'll never know, that it happened. And you say, well, how, you know, we made $1,000, from last month to this month, but how come this money is missing? That there's more. It should be 2,000 instead of 1,000. And where did it go? And unless you're able to kind of go in and look at it forensically and see, okay, how did this happen? And really go in and look at those monthly returns, or the monthly statements and the annual statements, and coordinate that together. And there's all kinds of great software that we use to input all that stuff, and it can do really wild stuff to see if there's fraud going on.
Okay. Um, and then you also listed selling away, which basically I think the red flag there is if your advisor asks you to write a check to someone other than the brokerage, right? Other than Fidelity
Correct.
or Schwab or whatever, Vanguard, whoever they're holding their funds under. If they're asking you to write a check to somebody else, then you should be concerned.
Absolutely. And what happens is, and it's a real easy sell for the broker to tell his client, yes, yeah, you're going to write this directly. This is a private investment. It's going directly to the manager, right? And investors won't necessarily think that's a big deal. That, typically, you're exactly right, Linda. Everything has to be written to the broker dealer, to the broker, the Merrill Lynch, the Schwab, the Fidelity. And if someone asks you to do something different, or to wire, hey, we could wire this money right out to this place. I mean, typically they won't do that because there's trail there. And if there was ever any type of compliance audit, and broker dealer software should pick up on that it's going out somewhere else, maybe not, but usually it'll be just to write a check, or write a check. They'll have them write a check to their bank account, have them go to them, have it go back to the client, and the client writes the check out of their personal account. So there's a lot less trail. But we're starting to see a lot more of that.
Okay. So were there any others that I missed that you were going over for advisor misconduct?
Those are the biggest. We talk about maybe a lack of diversification. Yeah, we see that, but that's not a huge issue. The unauthorized trading, that's big. Breach of fiduciary duty. Boy, I kind of wanted to say something about that.
Sure.
And I'm not going to mention any names. So brokers don't have a fiduciary duty. They have what's called regulation of best interest. They have to act in the best interest of their clients. But individuals who are registered investment advisors, or RIAs, they have a fiduciary responsibility, which means they absolutely have to act in the best interest of the clients. There are a number of large asset managers who basically claim that they have this fiduciary duty, and they're a much better option than just dealing with a financial advisor. And yes, they do have a fiduciary duty. But what's interesting is, and I've done some research on this, not enough to put in my book, and maybe if things slow down a little bit, I would really like to reopen this up. But I contacted a dozen or so clients from a very large asset manager. And basically, all of the risk reward profiles were about the same. And the returns that those 12 accounts earned was not only markedly different, however, they fell short of what the S&P 500 and what the Dow Jones index was doing by anywhere 1.5% to about 3% per annum. So I guess my point is that there's no way that investors can really know with transparency how well their portfolio may or may not do, as compared if they were just with a broker dealer that was putting them in a Fidelity fund or any type of index fund, right? And I think the major point is that, and it's borderline, I would say, maybe misleading, because sure, they have a fiduciary responsibility, But if they're not even earning what the S&P 500 is doing for a number of years, even though their clients are not very risk averse and want to take on risk, I'm not sure where the benefit or where the value is there. I think they're resting on that fiduciary term to earn trust, but in terms of what's actually happening, they're not meeting expectations in terms of what the market is doing as a whole.
Yeah, good points there, James. I love that you brought that up. The fiduciary duty is something that I talk about a lot, not necessarily on this podcast, but when I'm talking to people in everyday life, my clients. And it's something that is very confusing to people, but in some instances, it's cut and dry, whether you are or aren't. And some people think that just because someone has a CFP designation makes them a fiduciary, which it doesn't, because there are lots of CFPs that work in under broker dealers that earn commissions that that aren't acting always in the client's best interest.
Right. Specifically for clients of financial advisors or independent RIAs, make sure and you do a quick check. Make sure that the credentials that they say they have, they have. They're very easy now to go to CFP, or if they're CFAs, or to go to broker check and look at their history, look at their if they've anybody's had any complaints against them, look at how many firms they've been to. Probably most of these financial professionals will have LinkedIn profiles and kind of see what they have on there and just try to get an idea. And because they're licensed, it's taking a lot of legwork out because, there's no bad actors cannot be in the business, but still do your homework and kind of get an idea of what the backgrounds are before.
Yeah, absolutely. Great advice there. Okay. Anything else we should know about advisor misconduct before we go back to investment fraud?
That's pretty much it. I think a big thing is, and it still hasn't changed, is the failure to supervise. And that is something to where a broker who commits misconduct. And the reason why we say misconduct instead of fraud, I mean, a broker can't commit fraud. We say misconduct because when a broker is over trading or is switching mutual funds or annuities for a commission, they're not really stealing money. They're just doing activities where they're making a commission, but they're not stealing money. So that's what it's called, misconduct, right? In terms of actual embezzlement, are there brokers who will actually, we talked about selling away, who will actually steal money from a client? Uh, yes, thankfully, it's not quite that blatant other than selling away. And that's where that's called fraud. But in terms of the failure to supervise, back in the day, brokers had compliance officers that were pretty lenient in terms of how often they reviewed accounts, even with accounts that traded so much. For example, if money was going in and coming out of the account at a very high rate, if the trading activity or the types of investments that the account was holding, there would be red flags. Now a lot of that has been replaced by software, and it was very difficult back in the day to basically say you failed to supervise this broker, although that was the case. Now software, it's a lot of the stuff is being flagged early on. So it's definitely for the investor's benefit to do so. And understand, when you're a victim of investment fraud and you put in 50, 100, $500,000, more than likely by the time it comes to light, you're probably going to get pennies back on the dollar. Where if you're a victim of any kind of misconduct or even outright fraud from your financial advisor, the brokerage firm, the broker dealer is going to more than likely compensate its client, right? Because of the broker's wrongdoing, for their employees' wrongdoing. Will probably get censored, but you as the client will be compensated. So it's definitely a much easier path to resolution than investment fraud.
Yeah. And that coverage typically comes from their errors and omissions insurance or liability insurance, whatever you want to call it. Not the insurance expert there, but that's typically
Correct.
where those payments will come from. So it's also important to make
Yes.
sure that whoever you're dealing with is insured.
Yes, absolutely.
Yeah. Okay. Going back quickly to investment fraud and talking about, like you said, this is more about outside investments or private investments. So let's just do a
Correct.
quick overview of that before we wrap up.
Okay. So very quickly, in the last probably 5 years, cryptocurrency has been one of the leaders in terms of outside investments that people were losing money. And what's really taken over in the past probably year and a half, 2 years, it's what's called multifamily real estate investing, where and what we're seeing now is you'll have a husband and wife or two brothers that they'll own maybe 3 or 4 apartment buildings, and they want to scale up. Instead of buying a 3 unit or 6 unit, they want to buy a 20 unit or a 60 unit. So they'll put this paperwork together, legal paperwork, and they will raise money from outside investors so they can use their money to buy this property. And we're seeing a lot of fraud, unintentional, mind you, that's taking place, and they just don't know, kind of what they're doing on this large scale, and they're overpaying and they're not doing the right due diligence when they're actually buying the properties. I mean, one case, it was to buy 9, I think 20-unit buildings, and two of the buildings had asbestos. So they've got $25,000 in their reserve fund, yet they would have about a $700,000 fee for a company to come in and do it. And of course, they hid the fact that there was asbestos in there because they didn't spend the money and hire the right person to come in and do all of the work before they bought the property. So it turned out to where, the investors basically got nothing back. And it's a shame. But multifamily investing is huge. There's all types of advertisements on Facebook and Instagram about how good it is, and it is very good. There's a lot of advantages, but know who you're doing business with. And a lot of them have it's a 2-tier education, buyer education class. And now that you have this high level of knowledge, this knowledge base, now we're going to, why don't you partner with us, or why don't you partner with our students? And because you all speak the same language now, you've all taken the course, and it's awful. And unfortunately, I've done a number of podcasts for multifamily, and every time that, literally a day or two later, I get 25, 30, 40 phone calls about, they can't get their money out and everything. It's like, I'd love to help you, but it's too late now. You really needed to do the due diligence and see how many properties that they had go into foreclosure, or how many times the owner operators file bankruptcy. And it's real easy to kind of find if you know where to look, but after you invest, it's usually too late.
Yeah, great points. I think this is a great segue into this next question that I had for you, which is why do, intelligent, successful people fall victim to investment fraud? Because it's easy to do. So why is it so easy to do? Why do people fall into that?
Yeah, it's really easy to do. And I'm going to answer that with two parts. The first part is going to be, everyone does some level of due diligence, whether it's Mickey Mouse or whether it's really in depth when they initially invest. But because investment fraud typically doesn't start on day one, most investment fraud starts as a legitimate investment. And say everything is fine for 2 years. So someone did their due diligence on day one, everything's fine. And then at the beginning of year 3, in this case, the asbestos was found out, and the owner operators don't know what to do. So they have to start fudging numbers because they're pulling all this money out of everywhere else to funnel to that problem. And really, the beginning of year 3 is when the fraud starts. And because of that, since investors do initial due diligence, but they don't do periodic due diligence or have someone do it for them, and it's a much smaller version as the every year or every 6 months, but that would have been found out, and they probably could have got some of their money back, or maybe more of their money back. But after the fact, they just can't do it. So sure, do your initial due diligence, but you've got to do it I would say, at a minimum of once a year for private investments, because you never know when that catalyst is going to occur, when the economy is going to have a downturn, when something negative is going to happen. In my case, when, the trading losses are going to come. The second part of that, and this is actually in my book, and I find this really fascinating. The AARP did an investment fraud vulnerability study, and I list a handful of the key predictors of being a fraud victim. Number one, Male made up 80%, 81% of fraud victims. Victims are at least typically 70 or above. They have a conservative political ideology. They tend to be high frequency traders, and high frequency in there is 5 or more investments per year, which I wouldn't necessarily, I would say maybe 5 per day would be high frequency for me,
Yeah.
but
Everything's
okay.
relative.
Exactly. A preference for unregulated investments and valuing wealth as a primary measure of success. So I agree with all of that, with the only exception, and I don't know why, but it seems to me that the majority of people who contact me that I've worked with in the past regarding real estate, the multifamily fraud, are predominantly women and relatively successful women who are able to come in and invest 50,000 or 100,000 or a couple $100,000. But typically older males who are conservative is what they found out.
Interesting. Yeah, very interesting. And I wonder if that might be just because in that age group, it's typically just the men who were doing any investing. In that older age group, there weren't a lot of women that were
Yeah.
handling money to begin with.
For some reason,
Although,
I'm sorry, go ahead, Linda.
although the money may have transferred hands too from husbands to wives as the husbands expired. But yeah, that's just really interesting. Um,
Yeah. And this study was in 2017, so it wasn't all that long ago. But just to go back real quick to the previous point. So, we talk about, let me just say this in terms of most fraud doesn't start out as fraud. If
right,
someone is going to commit fraud from day one, it's relatively easy to spot. I mean, there's going to be red flags from day one, and the number of red flags that's going to be visible from day one to month 6 to year 1 is only going to increase. And that's relatively easy to spot. I mean, literally over the phone, if I'm talking to someone and they're asking me, hey, I've got this investment or that I either made or want to make, and just by telling me, I have a pretty good idea of what's going on. It's the cases where fraud doesn't start on day one. And that's the majority of cases. And I'm going to say anywhere between 2/3 to 3/4, fraud does not start on day one. And that's why it's so difficult to find, because when you do due diligence initially, you don't see the red flags, right? It's
right.
only after.
Yeah. Interesting. Okay, I always like to talk about mindset and internal obstacles. So I have a couple questions regarding that for
Sure.
you. The first one is, why do people hesitate to question advisors or investment opportunities?
Boy, I would say fear. It's the doctor syndrome. I mean, it's just amazing to me that even to this day, my parents' friends who are physicians, they don't refer to them as Bill or Tom or Nancy. They refer to them as doctor. Oh, hi, doctor. How you doing? And they've known these guys for years. I'm sure there's a psychological reason if it's, I'm here and they're here, but just this knowledge base that people attribute to someone else is to the point where maybe they feel that they're not there. They don't, maybe won't understand. I don't have the exact reason for it, but we see it all the time. And I think just a big fear of, how are these people going to look at me if I ask the wrong question or the dumb question, or if I push too much? And that's kind of all part of the, in terms of what I did. When clients would call me, and they would call me all the time, they could come to the trading floor anytime they wanted. And there was a few clients who were always not suspicious, but always just really wanted to know the root answer for everything, the root cause. And there's been a couple of times where, look, I mean, this is, I love you to death and you've been my client since day one, but I can't spend an hour a week answering what the market may or may not do. And, maybe you should, we could transfer your money to Schwab or Fidelity. That's exactly what I said. And what happens, of course, oh yeah, I'm sorry. Yeah. I get it. So it's just that whole looking up to someone who may or may not have earned it. No different than
Yeah.
a lot of bad actors, fraudsters, they'll donate, they'll go to charity events and they'll donate a lot of money. And it's this attribution of character that may not be real. Oh God, well, he just gave $20,000 to autism or $50,000 here. Well, he must be a good person. He's someone I want to do business with. You have no idea. I mean, I mean, I'm not saying it's not real. I mean, it could be real, but it's, maybe he's just doing it or she is doing it just to kind of play that role, because that's what someone, if they were successful and they were actually investing and making their investors money, that's what they would be doing. So,
Yeah.
yeah,
And my answer to the question would be that some people hesitate because they're just like, well, they're the expert. That's why I came to them. They're the expert. So whatever they tell me to do, I'm just going to do it because I don't know any better.
well, and there's nothing inherently wrong with that, but you should, it. Look, there's, when Google came out, there was a saying that, there's no reason for stupidity anymore, right? Because you could just go to Google and search. And now with, with YouTube and AI, especially AI, it's really easy to find the bullet points, the pros and cons, or the truthfulness or the validity of what someone tells you in an area that you have very little or no knowledge. And I think it's a great tool for investors to kind of, plug in there. This is what I said. This is what I asked. This is what they told me. What is your analysis? And it's phenomenal what AI will come up with. It's like, yes, this is good, but you should have asked them this, or hey, what about this? Or it's phenomenal.
Yeah. That's true. AI can be super helpful, but it also, there's so much information out there on the internet and even in AI right now that you don't even know what's true and what's not because of AI.
Right.
It's like, is
Right.
this true? Is this not true? So
Right.
that it can be good or it can be bad depending on how you look at it.
Sure.
Okay, one more question about mindset and internal obstacles.
Yeah.
Let's talk about embarrassment and shame and how fraud victims can be quiet about it and silent about it because they're embarrassed and ashamed because they've been taken advantage
Wow. You know, yes. So
of.
let me, my experience with this in terms of clients not wanting to come forward have been mostly with the consulting work that I do. So people will call me and they'll say, "Hey, a bunch of us invested in this, whatever it may be, right? And we lost this much, and we either can't find them, or they won't answer the call, or yeah, we'll get the statements that they're being sent tomorrow, or the money's coming next week. Oh yeah, one more week, whatever it may be." And I'll give them, they'll give me a list of names of other clients, and maybe some of them have contacted the SEC already. Good luck. And others have contacted the feds, the FBI, which was probably a much better choice. And I'll contact some of these people, and you think it'd be just the old ladies who would say, "No, I didn't do anything. I'm just waiting to see what happens." And it could be, they could be 25, they could be 75, and people, "No, I didn't say anything. I think it's going to turn around, and I'm not sure I believe this. And yeah, I was stupid. I didn't think about it." And yeah, I don't get it. I mean, if you know most of the fraud that I investigate is not, we're not talking like romance scams, and we're not talking about, the guy that's sitting at his house in Nigeria that's trying to get your money. I mean, these are people with high stature in the United States that have good backgrounds, and they've been investing for a long time, and they turn to be bad actors. And I don't understand why people are hesitant. I don't know. I don't have an answer. And I ask them very, very gently, what took you so long? I think maybe an area that I've delved into a little bit more is like the due diligence. It's like, well, did you look into this before? And I'm not saying that you had to go and buy a 300-page book and figure out how to read financial statements, but what kind of due diligence did you do? Did you make any phone calls? Did you have somebody look at it? And I'm more surprised that so few people do that, and they rely that, well, somebody else probably did it, or yeah, so my next door neighbor Tom, it was his buddy from work, and I know Tom's smart and he looked at it and he said it was okay. And you see a lot of that. But in terms of not coming forward, I mean, to the point to where law enforcement or the SEC will come and try to get a list of names of all the investors, then of course, everybody's coming out of the woodwork. But why nobody kind of complains, I don't know. Boy, if you have an opinion on this, I'd love to hear it.
I don't. I wanted to hear what yours was.
I don't. I don't get it. I can say, and I want to be really careful how I say this, but you know, people who purchase a private investment and don't do due diligence. I mean, it's really similar. I had a conversation that was just really unrelated, probably 4 or 5 years ago with my doctor. And we're talking, I don't smoke, but we're talking about smoking. And he's telling me the story about one of his clients who, he knew his dad. His dad passed away from lung cancer, and now he has lung cancer and he has probably 6 months to a year to live. And I'm thinking, boy, oh boy, you know, you, and he says, you smoke for 20 years and you know the risks and you've got the money to take whatever course or hire whoever you need to go and do it, and you don't do it. And yet you're surprised, you're flabbergasted when I tell you that you have cancer. And I know it sounds really bad, but people who invest, outside of what their brokerage firm offers, you don't do any due diligence. You don't look into who you're doing business with. You don't know exactly what you're investing in. And when you find out, when you get that call that it was a Ponzi scheme, you're surprised. And I know that sounds really, really harsh, but I think it's kind of tough love. It's kind of a wake up call that you've got to do your due diligence. I mean, you buy a book, hire somebody to go and do it. There's a lot of ways to get it done, but you have to do it. And please don't rely on the SEC or the Commodity Futures Trading Commission, which are the two largest regulatory agencies. And I'll say this, and I'll make this very positive for your audience. Love the SEC. The SEC are experts, but they are experts at not preventing fraud, but picking up the pieces after the fraud is discovered. They're great at that. But for them to actually give advice to investors, I mean, what do they tell you? Ask a lot of questions. Okay, what questions am I asking? Make sure you get everything in writing. Okay, I've got this much of documentation. What do I do? And of course, the granddaddy of them all, if it looks too good to be true, it must be. Well, what exact rate of return, Linda, does an investment have to show to where an investor would say, you know what, that might be too good to be true? Is it 10%, 12%, 50%? The fraudsters have gotten smart. You don't see a lot of these guys that are shooting 20%, 30, 50% rates of return. They know that if they're going to go after the high net worth accredited investors, they're showing returns of 6.5%, 7%, 8%. Madoff was 10%, 10.5% per year. So they're great people. They work hard. I'm sure they have in their heart that they want to prevent fraud, but they're experts at picking up the pieces when the FBI comes in and says, hey, there's fraud going on here.
Yeah, great perspective. Okay, let's start wrapping up here. Tell us about your book. We haven't talked about that yet. You've mentioned it a few times, but we need to know.
Yes. So, I've been working on a book for about 3-4 years. The title is going to be Investigate Before You Invest, which is also my website. It's going to be a 600 page plus or minus monstrosity. And it's an edit as we speak. And it was probably another couple hundred pages. And I've just been paring it down. And the first probably 2/3 of the book is going to be a lot of theory. What is investment fraud? Why does it occur? It's preventable. But if it's preventable, why does it happen so often? And then the last third of the book, I'm going to break down the red flags, maybe 50 or so red flags in a series of 4 chapters in how you investigate fraud. You're looking at the investment itself. You're looking at the investment firm, the principals, and then any third parties that are providing services to that investment itself. And I think it's going to be a great resource. I think it's going to be a game changer. There are a few good books that have been written on investment fraud and red flags, one by a very prominent attorney. But I think this is going to be kind of an A to Z approach. And I've spent a lot of time trying to making it really user friendly and easy to understand.
Great. Okay, so this is being recorded in February of 2026. It'll probably be a couple months before it comes out. But either way, keep your eye on the website, investmentfraudsolutions.com, so you can find out when James' book is going to be released. And then, James, otherwise, besides the book, who needs to find you? Who do you work with?
So primarily I work with high net worth accredited investors who are investing primarily in third party, what we call Regulation D exempt securities. It could be hedge funds, private equity, multifamily. It could be trading crypto. It could be a hedge fund that has investing in fine art. It could be any type of what we would call private investment. The other part of that would be if you are uncomfortable with the type of performance that you are receiving from your financial advisor or registered investment advisor, we will go in and take all of your statements and throw it into our software, and it will give us a report that will really show how well that you're being served by both your broker dealer firm and by your investment advisor.
Wonderful. Well, thank you so much for being my guest today, James. Lots of things to think about, and I really appreciate you sharing your story and your expertise with us.
Thank you, Linda. It's been a pleasure.
All right, real ones, here's your closing nugget for today. Investment fraud isn't about intelligence, it's about opportunity. When you know the red flags, you take away the fraudster's advantage. Thank you for listening to the end. Be sure to share this episode with anyone you think that it might help, and be sure to click that link to follow us and stay connected to Real Money, Real Life.
Thanks so much for listening to Real Money, Real Life. Want to see what's blocking you from financial confidence or discover your money personality? Head to the resources page at lindagriz.com for our free quizzes. That's LINDAGRIZ.com/resources. If you're loving what you're learning, be sure to subscribe and leave a review. I'm your Me Money guide to financial clarity, Linda Grizely, and I'll catch you next time as we talk more real money, real life, because you deserve to feel confident with your money and good about how you spend it. The content shared here is for educational and entertainment purposes only. It is not financial, tax, legal, or planning advice and does not constitute therapy or mental health counseling. Please consult an actively licensed and qualified professional for advice or help specific to your situation.